All right, so today we're going to be taking a deep dive into dividend reinvestment plans,
Okay.
or as most people know them, DOPOPs, using the info that you've provided. Um, you know, our listeners already know the basics, right? A DRP lets you automatically reinvest those dividends to buy more shares of the same stock. But we're going to go deeper than that. We're going to be looking at, how this strategy can work for you and uncover some of the nuances that maybe you haven't thought about.
Yeah, absolutely. I think people think of DRPs and they're like, oh, set it and forget it. But there's so much more to it than that. And really, it can be a powerful tool for building wealth over time. But you do need to understand the mechanics and, the different approaches that you can take.
Yeah, for sure. So let's lay the groundwork. Investopedia defines a DRP as a program offered by companies and closed-end funds that lets you reinvest those dividends. And we're talking about roughly 650 companies and 500 closed-end funds that are currently doing this.
Right. And this isn't just about buying whole shares either. You can also purchase fractional shares through DRPs. So that means even small dividend amounts can be put to work, maximizing your investment. It's essentially automating that compound growth snowball effect.
That's right. So, our source seems to prefer having some manual control. Why would somebody choose to do that instead of just letting everything happen automatically?
Well, that's where the strategy comes in. Manual DRPs let you diversify your investments. You can take those dividends, and instead of buying more of the same stock, you can direct them to a different company altogether.
So you could be receiving dividends from like a stable blue chip company, but then using those dividends to buy shares in like a high growth tech company.
Exactly. You have the flexibility to capitalize on different opportunities in the market. And, that way your DRP strategy can evolve and adapt as your goals change.
Now that brings us to a pretty bold claim from our source. They say that DRIVs have the potential to double or even triple your investment over 20 years. How realistic is that?
Well, let's be clear, right? There's no guarantees in the stock market. But this claim highlights the power of compounding over time, especially when you pair it with a DRIP. Even small, consistent reinvestments, when you combine those with, potential share price appreciation and dividend increases, it can make a big impact over the long term.
Okay, so our source, they actually use a Coca-Cola example to kind of illustrate this. And the numbers are pretty eye-catching. They're talking about a Roth IRA with $7,000 annual contributions, 10% annual interest, and a 3% increase in share price and dividend yield. And they claim that with just $583 invested monthly in Coca-Cola over 20 years, you could reach a portfolio value of over $265,000 and generating over $8,600 in annual dividend income. Is that really possible?
Well, it is a hypothetical example, but it does show the potential of long-term retirement-focused investing with DRPs. All those factors they mentioned, the consistent contributions, the steady growth, and then that compounding effect, they all play a part in that result.
The source also emphasizes the cost-effectiveness of DREPs, even going so far as to call it, free shares. What's that all about?
Well, think about it this way. When you reinvest dividends through a DREP-D, you're buying more shares without spending additional cash out of your pocket. Those reinvested dividends are essentially buying those extra shares for you.
So it's reducing the overall cost of building your portfolio because those dividends are doing the heavy lifting.
Precisely. And this ties into the long-term growth. By reinvesting consistently, you're capitalizing on those market upswings, riding out the downturns, and steadily accumulating more shares along the way.
And let's not forget about the flexibility we were talking about. You're not locked into just buying more of the same stock, right? You can, strategically direct those dividends to different companies or sectors to diversify and potentially enhance your returns.
Absolutely. DRPs offer that level of customization. You can tailor your approach to meet your specific investment goals and your risk tolerance.
But there's this recurring theme here. It's the importance of a long-term mindset. Why is that so crucial when it comes to DCREPs?
Well, DCREPs are not a get-rich-quick scheme. They're about building wealth gradually and consistently over time, and that magic of compounding unfolds over years, not days or weeks.
So if we're thinking about real-world application, imagine you're starting today. How would you leverage that flexibility that we've been talking about?
Well, the first step is identifying those long-term goals. Are you saving for retirement? A down payment on a house? Once you know your goals, you can research companies that align with those objectives and, look for companies with a solid track record of dividend payments and growth.
And that's something for you, our listener, to think about. What are your long-term goals, and how could DRIPs help you achieve them?
Keep in mind, thorough research is essential. Look into the company's dividend history, their financial health, and how their future prospects fit into your investment timeline and risk tolerance.
Okay, so we've laid the groundwork. We understand what decreepers there, their potential for building wealth, the importance of a long-term mindset, but we've only scratched the surface.
Right.
In our next segment, we'll dive into those practical aspects of decreeps.
Yeah, we'll explore the benefits in more detail. We'll look at the potential drawbacks, things you need to be aware of, and we'll discuss how to actually get started with a DRAP.
Stay tuned for part 2, where we continue our deep dive into the world of decreeps. Welcome back. So now that we've got a handle on, what DRIPs are, let's get down to the practical stuff. What are the, real advantages that you as an investor can expect?
Well, one of the most significant advantages, and we touched upon this earlier, is the cost savings. DRIPs can help you bypass those brokerage commissions, those pesky fees that can eat into your returns when you're buying individual stocks the traditional way.
Right, so every dollar you save on fees is a dollar that's working harder for you within your investment.
Exactly, and this is especially beneficial for, people who are just starting out. Maybe they're working with limited capital.
So how do DRIPs stack up against other popular investment vehicles, like ETFs?
That's a great question. ETFs have become incredibly popular in recent years, and for good reason. They offer diversification, and they're typically very cost-effective. But DRIPs can actually be even more cost-efficient over the long run. With an ETF, you're going to typically pay an annual expense ratio. It's a small percentage fee, but it's charged to manage the fund. With DRIPs, you often avoid those recurring fees altogether, and that allows more of your returns to compound over time.
So while both ETFs and DRIPs are generally considered cost-effective, DRIPs can squeeze out that little extra edge in the fee department.
Yeah.
Especially over those longer periods.
Exactly. And let's not forget about the psychological advantage of DRIPs. Automating your investments can really take the emotion out of it.
Right.
You're less likely to make those impulsive decisions based on market swings because your dividends are consistently being reinvested regardless of what's happening in the short term.
Yeah, that's a huge point. I mean, removing that emotional roller coaster can make investing, all less stressful and way more disciplined.
Absolutely. However, it's important to acknowledge that, like any investment strategy, DRIPs do have potential downsides.
Okay, let's talk about those.
Yeah.
What are some things our listeners should watch out for?
Well, one consideration is the tax implications. Even though you're not receiving those dividends as cash in hand, you're still liable for taxes on them. And this is particularly relevant if you're invested in a taxable brokerage account, as opposed to a tax-advantaged account like a Roth IRA.
So you got to factor those taxes into your overall investment strategy, especially if you're not working with a tax-sheltered account.
Absolutely. Another potential drawback is the lack of control over the purchase price. When you're using a DRP, shares are automatically bought at the prevailing market price. That means you could end up buying shares when the price is a bit inflated, compared to if you were manually buying them during like a market dip.
Yeah, that makes sense. You're giving up a certain amount of control over that price in exchange for the convenience and the automation.
Right. But it's important to remember that over the long term, these price fluctuations tend to even out. As long as the company continues to perform well and grow its dividends, those short-term price swings become less significant in the grand scheme of things.
Right. It's about that long-term perspective again. So let's say someone is intrigued by the potential of DRPs and they want to get started. What are the steps involved?
Well, the first step is to identify companies that offer a DRIP program. Usually this information is readily available on the company's investor relations website, or you can contact their investor relations department directly.
So it's not like a universal feature. You have to specifically seek out companies that have chosen to offer this program to their investors.
That's correct. Once you've found some suitable companies, the next step is to check with your brokerage firm. Most major brokerages offer seamless DRP enrollment within their platforms.
Okay, so if your brokerage offers it, the process should be pretty straightforward. What happens next?
Once you're enrolled, you typically have a choice. You can choose to automatically reinvest all eligible dividends, or you can opt for manual control.
Ah, so that's where that flexibility comes in. You can tailor it to fit your personal style.
Precisely, if you prefer a more hands-off approach, the automatic reinvestment is great. But if you want to be a bit more strategic, you can manually direct those dividends to certain companies, or even hold them as cash for future opportunities.
It's like choosing between having a personal autopilot or taking the wheel yourself. Now, what about ongoing management? Is a DRP truly set it and forget it? Or is there a degree of monitoring involved.
Well, while DRPs are relatively low maintenance, it is important to periodically review your portfolio, monitor the performance of those companies that you're invested in, assess their dividend payout ratios to gauge their sustainability, and just make sure that your DRP strategy still aligns with your financial goals, which might change over time.
So it's not about completely ignoring your investments. You still need to stay informed and make adjustments as needed.
Exactly. Think of it as a regular checkup for your portfolio, just making sure that everything's on track and performing as expected.
All right, that makes sense. Now let's think about somebody completely new to invest in, someone who's maybe a little intimidated by the stock market. Could DRIPs be a good entry point for them?
Absolutely. DRIPs can be a fantastic way to dip your toes into the world of investing. They offer a very simple automated approach, and they don't require a large initial investment or, extensive market knowledge.
Right. So for those who are hesitant to kind of jump into the deep end, DRIPs offer a more gradual, almost guided entry point.
Precisely. And because DRIPs typically allow for the purchase of those fractional shares, even small amounts of money can be put to work. So it makes it a lot more accessible and less daunting for beginners.
That's a great point. Are there any particular types of investors who might benefit the most from using DRPs?
Well, long-term investors, especially those saving for retirement, they often find DRIPs particularly attractive. The power of compounding is most pronounced over those extended periods, making DRIPs an ideal vehicle for retirement planning.
So starting early and letting those dividends compound over decades can lead to some significant wealth accumulation.
Absolutely. Additionally, investors who prefer a more hands-off approach, or maybe they just lack the time to actively manage their investments, they can really benefit from that automated nature of DRIPs.
It's almost like having a silent partner working tirelessly to grow your wealth. You set it up, and then those reinvested dividends do the heavy lifting.
Now, are there any specific industries or sectors that tend to be particularly well-suited for DRIP investing?
That's a good question. What comes to mind?
Well, companies that consistently pay dividends. Those in stable, mature industries like utilities, consumer staples, healthcare, those are often favored by DRIP investors.
Because they generate consistent cash flows. And they have a track record of sharing those profits with their shareholders.
Exactly. However, as always, diversification is key. Don't limit yourself to just one sector. Spreading your DRIP investments across different industries can help mitigate risk and potentially capture growth opportunities across, different segments of the market.
Okay, so we've covered a lot of ground here in this part of our deep dive. We've explored the, practicalities of DRIPs, from the advantages, the potential downsides, to how to actually get started. What key takeaways would you want to highlight for our listeners as we wrap up this segment?
Well, I think the main takeaway is that DRIPs offer a very compelling and accessible way to harness the power of compounding. To build wealth steadily over time, they're cost-effective, they're flexible, and they can be tailored to meet your unique investment goals and risk tolerance. While DRIPs aren't without their drawbacks, their long-term benefits, particularly for patient and disciplined investors, can be pretty substantial.
Yeah, I like that. It's a balanced perspective, highlighting both the opportunities and the potential challenges. So we've learned that DRIPs can be a valuable tool for both seasoned investors and those just starting out. In our final segment, we're going to go beyond the basics. We'll explore some advanced DRIP strategies, and we'll provide some practical tips for maximizing those returns and taking your DRIP game to the next level.
Yeah, and we'll look at some real-world examples of how successful investors have used DRIPs to build their wealth over time.
All right, so welcome back to our final deep dive into DRIPs. We've gone from the basics to the practicalities, and now it's time to unlock some of those advanced strategies, those tricks of the trade that can really boost your returns.
Yeah, it's like taking our DRIP knowledge from, a basic bicycle to a high-performance race car. We've laid that foundation, and now it's time to fine-tune the engine.
I love that analogy. So where do we start with these advanced strategies?
Well, one powerful approach is to focus on companies with a history of consistently increasing their dividends over time. These are often called dividend growth stocks, and they can be a real game changer for your portfolio.
Okay, so instead of just looking for companies that pay dividends, we're seeking out those that have a track record of actually raising those payouts. Why is that so powerful for DRIP investors?
Well, imagine this. You buy shares in a company that's paying a $1 dividend per share with a DRP. That dividend buys you more shares, and then those new shares start generating dividends too now. If that company increases its dividend to, say, $1.10 per share, the next year, your reinvested shares are now earning you even more.
So it's like a double dose of that snowball effect. Not only are your dividends buying you more shares, but the dividends themselves are getting bigger.
Exactly. It's a strategy that really rewards patience and that long-term thinking.
Okay, so let's talk about diversification across different industries.
Right. Diversification, it's the golden rule.
We hear it all the time, but why is it so crucial specifically for DOPs? I mean, if we're focusing on solid dividend-paying companies, wouldn't they all be, somewhat resilient anyway?
Well, it's true that, companies that are committed to paying dividends are often more financially stable, but each industry faces its own unique risks and opportunities. Let's say, for example, you had all your DRIP investments in the energy sector. What happens if oil prices suddenly plummet?
Okay, yeah, I see your point. Even the strongest dividend payers can be affected by factors outside of the control. So by spreading our investments across different industries, we're essentially creating like a safety net for our portfolio.
Exactly. If one sector struggles, others can potentially offset those losses, and that helps create a more balanced and resilient portfolio over time.
All right, so let's move on to some practical tips for maximizing those DRI returns.
Okay.
What are some of those insider secrets that can help us squeeze out every bit of growth from our DRI?
Well, one of the most valuable tips I can offer is to be patient and disciplined. DIPs are a long-term game. It's really important to resist that urge to tinker with your portfolio too often or react emotionally to short-term market fluctuations. The stock market's like a roller coaster. There's going to be ups and downs. But over time, the overall trend has historically been upward.
It's all about that time in the market, right? The longer you stay invested, the more likely you are to ride out those dips and come out ahead.
Exactly. So, don't jump ship when the market gets turbulent. Stick to your plan. Trust the process. Let time work its magic.
Got it. Patience is key. But you also mentioned regular portfolio reviews. How often should we be checking in on our DIPs and what should we be looking for?
Well, I recommend reviewing your DIP portfolio at least once a year, maybe even semi-annually. During those reviews, you want to assess the performance of the companies. Are their earnings growing? Are they maintaining or increasing their dividends? Are their payout ratios sustainable? And also make sure that your DIP strategy still aligns with your overall financial goals.
Right. So it's about being proactive, staying informed, and making adjustments when necessary. It's not about just completely ignoring your investments once they're set up.
Exactly. Knowledge is power. The more you understand about those companies you invest in, the mechanics of DRIPs and, the very strategies that you can employ, the better equipped you'll be to make those informed decisions.
That's a fantastic takeaway from our entire deep dive into DRIPs. It's about combining that initial set it and forget it simplicity with informed decision-making and those periodic reviews.
Right. Remember, even with a passive investment strategy like DRIPs, you're still the captain of your financial ship. You set the course and you make adjustments to navigate, those inevitable storms and reach your destination.
I like that we're empowering our listeners to take control. And the beauty of DRIPs is that they can be that steady engine propelling you forward.
It's like planting a seed and you nurture it with patience and consistency and you watch it grow into a, mighty financial tree.
Ooh, what if we took that analogy one step further? Imagine a forest of those financial trees, each representing a different company or sector, working together to create this really strong investment ecosystem. That's the power of DTRIPs, combined with that diversified and well-thought-out investment strategy.
That's a beautiful image.
So as you explore DRIPs, think about how you can create your own financial forest, one carefully selected investment at a time.
Remember that the journey of 1,000 miles begins with a single step. Start small. Stay consistent and watch your financial forest flourish over time.
That's a perfect note to end on. Thank you for joining us on this deep dive into DRIPs. We hope you found it informative and empowering. Happy investing.